Poised for Exit is a show for business owners who want to achieve a successful exit based on their own terms. Your business exit will likely be the biggest financial transaction of your life, and for most, you'll have one shot at doing it right. The topics and guests we feature and the stories they share will provide valuable ideas and strategies to improve operations and grow enterprise value so you can achieve the best possible exit outcome. Now here's your host, award-winning certified exit planning advisor, Julie Keys.
Welcome everyone to the Poised for Exit podcast show. Our guests today are two investment advisors who are going to share some tax strategies for business owners from a real estate angle that are probably strategies that you haven't heard of before. So you're going to want to listen in on this episode, and we'll hear from them as soon as we hear from our show sponsors.
Exiting your business is a big deal, both financially and emotionally. I'm John Marquet, Certified Exit Planning Advisor with TrustPoint. We help business owners transition smoothly on their terms. Our focus is on maximizing value, minimizing stress, and giving you confidence in what's next. Whether you're selling or passing the torch, we make the process seamless. Start planning today at trustpointinc.com. That's trustpointinc.com.
My name is Todd Crow, and I'm the president of the Twin Cities Exit Planning Chapter. If you're a business owner and advisor and want to learn more about the world of exit planning, you're invited to visit the Twin Cities chapter of the Exit Planning Institute. You can expect top-level education delivered by subject matter experts at every monthly meeting. Grow your network and draw from the learning that could be a game changer for your business or your practice. There's no pressure to become a member, so come and see what the buzz is all about. Our meetings are held the second Wednesday of the month, 7:30 to 9 a.m. See the show notes for more information and registration links.
Thinking about selling your business in the next few years? Don't wait to start planning. I've seen too many business owners wait too long and regret it. Freedom Financial Partners are financial advisors who specialize in exit planning for business owners, helping you reduce tax surprises, protect what you've built, and quantify how much you need from the sale. Their proven process helps you think beyond your business so you can move forward with clarity and confidence. The longer you wait, the fewer options you may have. Download your free financial readiness assessment today at ffpforme.com/exit. That's ffpforme.com/exit. Are you a business owner getting ready to transition? If so, I recommend True North Mergers and Acquisitions as your confidential strategic partner. They understand your business sale isn't just about one buyer and the price, but what you net that counts. In other words, what you get to keep. When you're ready for a higher level of representation that delivers consistent results, contact True North M&A to do the heavy lifting of selling your business. Learn more at tnma.com. That's tnma.com.
Hello, Poised for Exit listeners. Have you ever wondered how some real estate owners seem to unlock massive value from their properties without selling and paying huge taxes? Here's the reality. Baby boomers are sitting on trillions of appreciated real estate today. Who knew? I mean, we all know about the different stats we've heard with boomers owning companies with those nest eggs tied up and lots of value there. But now we're talking about real estate. So for many, the time has come when holding on to these assets is no longer practical. And managing them is also not something that they're interested in doing or even able to do, but yet there's an issue with the families, right? The families don't necessarily want to be taking it over. And so we're looking at in the next 20 years or less, about $16 trillion worth of real estate wealth is going to be passed down to the next generation. So we're going to be talking about this topic today and talking about some alternatives that business owners who own a lot of real estate in different sectors could probably take advantage of by working with these experts. We're covering this topic today with two great guests, Yan Arsenault and Nolan Gaffney, who are both from TrustPoint. TrustPoint has been a longtime sponsor of this show, and it's super to have you guys here on the show. And welcome back, Yan and Nolan.
Thank you, Julie. Happy to be here.
Happy to have you. So before we get started, let's just give our listeners a little bit of background. For those who aren't familiar with TrustPoint, let me just say they have been helping families, businesses, and nonprofits for over 100 years. And like I said, they have been supporters of this show for a long time. They're a super client-centric firm. The mission of simplifying and securing your wealth I know and work with many people at TrustPoint and highly recommend that firm for a lot of reasons. But let's talk about the two of you so that our audience can get a little bit of background before we get into our content. Yan, tell us about you and what you do for the firm.
Yes, so I have been with TrustPoint for 13 years now, and I currently serve as the Chief Investment Officer. So, as the CIO, I oversee our investment strategy, department initiatives, and I also work closely with our clients. But I would say more simply, Julie, my job is to make sure people feel at ease about their money and feel confident it's working for them and their family's future.
And that really is part of your culture. That is how your client relationships roll there. Like you have their back and you make them feel at ease. I love that. So thank you for sharing that. Nolan, tell us about you.
Yeah, I'm a portfolio manager here at TrustPoint. I spend my time helping clients align their investments with their goals and objectives, whether that is equities, fixed income, or what we'll be discussing today, real estate. I really enjoy helping families think more long term, connecting what they own today with the legacy they want tomorrow. And lately, a lot more of our clients are wondering about leaving properties to their children. They don't want their kids stuck with the burden of managing the property after they're gone. And our role at TrustPoint is to assist in that handoff and help simplify it.
Perfect. Yeah, I know you work with a lot of family-owned business. That's a really great business model and service that you provide so many different services within that sector, just because there's so many of them out there, right? And so if someone owns an investment property and they're ready to let go of it and they no longer want to be the landlord, so to speak, what are some of the options that they might have?
Yeah, so there are basically three options. Option one, they can sell the property, the investment property that they have, but
Mhm,
they will likely lose 25 to 30% or even more
mhm,
right off the top to various taxes, such as state and federal capital gains tax, depreciation recapture, and net investment income tax.
mhm.
That's option one. Option two, you can donate your property to a charity or fund what's called a charitable remainder trust.
Sure.
That's an option as well. Finally, option three, and maybe option three is the option that not a lot of folks know about. You can actually sell your investment property and reinvest the proceeds using a 1031 exchange into something called a DST or use a 721 exchange. These are both strategies that allow real estate investors to defer taxes on a sale and really transition from active hands-on property ownership to passive real estate investor.
And the DST and 721 strategies that Jan mentioned doesn't only benefit the current owner, but their heirs too. And we think about surviving spouses or kids who either simply don't want to, or maybe even aren't even equipped to deal with managing these properties. Planning
Mhm.
ahead with these strategies can help them avoid inheriting stress and instead inherit wealth.
Yeah, no kidding. I mean, that's huge, right? Because, we talk about this, we have these situations with our clients and many times the people who would be considered the quote unquote heirs are not interested, or they're not qualified, or they're not local, or whatever the reasons are, right? They're tied up in their own lives. And so making it a non-event, making it something that would be not only protect, save money on taxes, but also save them from the big headache. So let's talk about the DST. I want to hear more about that.
Yeah, so a DST, which stands for Delaware Statutory Trust, is essentially an investment trust that owns and operates institutional grade investment real estate. And despite the name, Julie, neither the property nor the investor needs to be located in Delaware. In a 1031 exchange utilizing these DSTs,
Mm.
instead of exchanging into another physical property, you can use the proceeds from your property sale to buy fractional interests in a number of different DSTs. So, in the simplest of terms, you can exchange your current property for passive ownership in a number of properties, still receive those monthly cash flows, all without realizing taxes upfront.
Investing in the DST essentially means saying goodbye to what we call the three T's: tenants, toilets, and trash. Or in the DST, it's important to understand that you're no longer the property manager, but you still get the upside of real estate. You still get these steady cash flows. you get the capital appreciation over time, and more importantly, you get the tax deferral of capital gain and depreciation recaptured taxes. So there are also other upside. Minimums with DSTs are relatively low, often in the $50,000 to $100,000 range. So you can take the proceeds from a sold property and easily spread them over different DST investments. And that way you can get exposure to different property types. And so in multiple locations across the United States, if desired.
Okay, so then is there anything detrimental to choosing this option?
Well, one of the bigger downsides is that they are illiquid. You can't just cash out anytime you want. The holding period for DSTs is usually 7 to 10 years, and you do give up control to the real estate company known as the sponsor that puts the deals together. So the sponsor manages the property or properties inside the trust, so you don't have to, but does ultimately decide when it's the best time to sell and return money to investors. When the money is returned back to investors, they have a couple options. They can either take the cash that would trigger taxes and pay those taxes, or they can do another 1031 exchange into another DST to continue to defer the taxes on and on and on.
Yeah, for sure. All right, well, let's talk about a real life example. Have you got a client story that you can share with us that kind of illustrates this?
Yeah, so we're actually currently working with a couple who has about 10 million in highly appreciated real estate in Minnesota, and managing it is burning them out, right? And keeping them also from relocating to a different state with a more favorable climate all year long. So before meeting with us, they thought their only option, their only choice was to do another 1031, traditional 1031 exchange. But once we introduced them to DSTs and we walked them through the steps that could essentially free them from the 3Ts and allow them to relocate, they were completely on board with the plan. So shortly here, this couple will be transitioning their real estate portfolio that they currently have in Minnesota into 6 to 8 DSTs invested across the United States, and they will be deferring all taxes in the process.
Wow, and you guys manage all of that.
We do.
Wow. All right. So let's talk about the other alternative that you mentioned earlier in the show, Yan, the 721.
Yeah, just using the same example I was referring to, some of the DSTs that they will be investing in will allow them to potentially convert their DST fractional interest into operating partnership units of a REIT under Section 721 after just a couple of years. So it gets a little technical here, but let me just explain maybe what's a 721 exchange and how it works.
Yeah,
it's a different section of the IRS code. And in the 721 exchange, investors exchange their ownership in real estate, often through a DST, for, again, operating partnership units of a REIT. So as you know, Julie, REITs own and operate a diversified portfolio of hundreds of underlying properties, right? And for many owners, the appeal of the 721 of REITs is really liquidity. Unlike DSTs, which can stretch out 7 to 10 years, a 721 up REIT gives you units. Think of those as shares that are easier to cash out when you need access to cash.
And for that reason, 721 up REITs are becoming very popular with advisors and estate planners, working with those clients who are looking to simplify their estate plan.
Sure. So they're not just about tax deferral, they're about turning those complicated situations and assets, whether it's farmland, right, commercial, or even rental properties.
Exactly.
Into these, yeah, wow, that's amazing.
It's all about peace of mind. You're simplifying things for yourself today while getting all those benefits that we've talked about, but also leaving something behind for your heirs that is easy for them to benefit right away as well.
All right, so now that we've talked about these strategies, who's the primary candidate, or who are the typical primary candidates for these kind of strategies?
Yeah, well, I'd say if you own investment property that has gone up in value, or maybe you've depreciated it over time, for whatever reason, you've been thinking about selling, maybe you're sick of day-to-day management, you want to diversify your real estate portfolio, or again, start to think more about your estate plan, but maybe the tax consequences from that sale have stopped you from doing that in the past. This is worth a conversation. We're happy to sit down, review all the details, cover your options, and ultimately determine if this is a good fit or not.
So just thinking, there's actually several people I know who own property management companies, some residential, some commercial. Are they candidates for something like this? A lot of the real estate is owned by them. They don't just manage it. Like you probably couldn't do a mix. I guess that's what my question is.
Yeah, no, what we're talking about here are owners of real estate properties. So maybe
Yeah.
you're referring to that as you're talking about property management companies. Now, there are specific restrictions and rules around what's eligible and what's not.
Yeah.
Every situation is different. So, no, we would have to look at the situation. But now,
Yeah.
what comes up is now a piece of real estate may be now stuck in a business sale, right? So the business owner may not be thinking about the value of the real estate within the business and the ability really to carve that out of the sale and do a 1031 exchange with that piece of it. And that's something that we have seen and can be advantages for, again, business owners that have some real estate value in the business.
Yeah. Like they own a bunch of apartment buildings or like that.
Yeah, I mean, we have come across certainly situations where people own multiple apartment buildings. And
Mhm.
often what we see is these owners are very centralized when it comes to the location, right? They have all these apartment buildings in one location, and it's now expected because they are involved in the day-to-day management of these units. But it brings a risk as well, right? So we talk about
Mhm.
diversification all the time when we talk to our clients. The same logic applies with real estate, right? The ability to diversify not only across different types of real estate, but also from a location or geographical standpoint often makes a lot of sense. So DSTs are very good for that because, again, the owner selling a piece of real estate, moving into DST investments, has the ability to select where these investments should be. And we see deals across the entire United States. So,
Awesome. So for business owners that are thinking about selling their businesses, these strategies could definitely help them out.
yes.
Mm-hmm. Mm-hmm. Any other client situations or cases that you could cite that help us illustrate?
We have another example of a client that we've helped earlier this year. Again, here we had different office buildings, apartment buildings in one location. Similar situation than the example that I was mentioning earlier. There was a potential desire to move to a different state, desire really to not have to worry anymore about
Mm.
day-to-day management. Now, at times we hear from clients that they have the ability to hire a property management company to do the hard work is certainly a possibility, but we all know that real estate owners, even if they're working with a property management company, they tend to be involved, right? And maybe at times more involved than they would like to be. And
Yeah.
that's when DSTs and the 721 appraise really come into play.
No kidding. All right, so aside from real estate, though, we've got, I'm sure, lots of listeners out there who are thinking about what kind of capital gains liability they're going to have when they sell their business or sell the stock of the business. What are some of the tools that you have available that can help them with that, defraying or deferring?
When you're thinking about other kinds of capital gains, whether it's stocks or cryptocurrencies, or we talked about business sales or
Mhm.
collectibles, any kind of gains really, this is often when we have conversation with our clients about qualified opportunity funds.
Mm.
They go, you're going to hear QOFs or QOZs. The idea with qualified opportunity funds is to really encourage investments into lower income communities by giving tax incentives to investors.
Sure.
So, no, the investment in a qualified opportunity fund are generally real estate development projects in
Mhm.
underdeveloped neighborhoods. So QOFs can offer, I would say, probably bigger upside potential, but they tend to be riskier than DSTs or uprates.
Is that the same as a qualified opportunity zone or an opportunity zone when you say QOZ?
Yeah, well, QOZ, the opportunity zones are the zones that have been kind of marked
Okay,
per se by the IRS
sure.
where investments can take place. And the qualified opportunity funds are the vehicles that are utilized to invest
Sure.
in projects that are part of these opportunity zones.
Excellent, excellent. Well, great. Was there anything else that you wanted to talk about or share that I didn't pick up? This has been a great conversation. I've never covered this topic on the show before. I'm really glad that we talked about this today.
Well, one thing we always like to talk about with clients is to just start to plan early. A
Yeah.
lot of these tools only work if you line them up before the sale.
Yes,
Too often, I'm sure you've seen it too. We've seen clients come to us kind of well after the fact that some
I
of the
know.
options are available and it's just simply too late. So I'd say if you own investment property, even if you're not ready to sell it yet, reach out. We can get much more in depth into more of the education, go over all the options. So in the event that it is a good fit, when you are ready to sell, we have a plan in place to execute in a tax and time efficient manner.
And any other takeaways, bits of advice, resources that you'd like to share before we wrap up?
Yeah, so we talked about DSTs today, 721 up rates and qualified opportunity funds. I think the listeners have to know that these are not strategies only for the ultra wealthy, right? So they can
Mm.
help a wide range of investors. And I think with the right team guiding you, it's not that complicated. So we do, Julie, have resources available on our website, www.trustpointinc.com. You can just type DST in the search bar, or you can give us a call. We're happy to evaluate your own situation and help if we can.
Well, we will certainly have your contact information and, of course, a link to the website in the show notes and in our social media posts. I would recommend that whoever is listening and is interested in this kind of strategy or just wants to learn more, that they reach out to you. Yeah, I really appreciated having you on the show. And gosh, what an eye opener to know that there's so much real estate sitting out there. Like I had no idea it was that much. And we definitely don't want the IRS to get more than they need to, right? We want to protect our clients. And so that's what we're here for. Nolan, Yan, thanks so much for being on the show. And thanks again for all your advice and recommendations, and to our listeners for joining us as well. Please do share this with your colleagues and your business owner clients, and we'll see you again next time.